Hey, thanks for joining me. It's October the 16th, 2022, and I'm talking to you from Phuket, Thailand, where I live. I've been lucky enough to meet some people lately. People have reached out to me after the video I did, a couple of interviews I've done with Etienne. So it's been really great. I've really enjoyed it, and I've met some very nice and very interesting people. A guy I met the other day, hi John, if you're watching, he's 30 years old, and it made me realize, he was asking me loads of questions, and I really enjoyed, once I get going on this subject of trading and the economy and everything else, I don't really stop talking, so sorry John if I went on too much. But it did make me realize that there's a lot of people out there, especially young people. Of course, you haven't lived through what I've lived through. I started on the London Stock Exchange floor in 1987, and apart from the experience that I've got from trading and technical analysis, I've also lived through the highs and lows of inflation over the last 35 years. And I studied economics, so I had a basic understanding, but of course living it day to day, seeing the numbers released, reading the articles in the Financial Times on the way to work, that kind of thing, it gave me a half decent understanding of the economy. But as I say, I'm not an economist, so these are just going to be my views on inflation. I'll give you a very brief history of what I've seen over the last 35 years and what that leads me to believe going forward. But again, I haven't researched this. These are just thoughts off the top of my head and some experience going forward. And really what I want to do is try and provoke a little bit of discussion, hopefully in the comments below. So if I'm saying something that you think is rubbish, please tell me, hey, look, you've got that wrong, or give me your opinion, or if you agree or disagree about what's happened in the past or where we're going in the future. I really would love to hear from you. So I'm just going to explain that in 1987, I started working on the London Stock Exchange floor in the traded options market. This was in April. I was 19 years old. By October 1987, of course, we had the stock market crash, which I'm showing you on the 10-year bond yield chart here, the monthly. Now, this candle here, this big red engulfing candle, is actually October 1987. So I don't remember what happened to bonds in that time, but I'm pretty sure that what would have happened is stock market crashed, and of course bond prices go through the roof. So it was as the economy may slow down, there may be some financial problems in the system, bonds tend to rally and interest rates tend to drop. So big bearish engulfing candle there indicated that probably we were all going to continue the bearish path for interest rates. Now, don't forget, coming in the 80s, we were coming out of that whole inflationary period was put in charge of to take care of, and he crushed the economy with high interest rates. No one in the last 2 decades has really heard about that, but maybe a lot of you have heard about Volcker and his inflation policy and high interest rate policy, which crushed the economy and destroyed inflation in the process. But we were just coming out of that period, as I say, in 1987. So stock market did recover, but interest rates continued to fall. Now, what was happening was central banks were obviously petrified of repeating that high inflationary period, which is so destructive to the economy because it does lead to very high interest rates, and people can't deal with prices going up every week, every month, plus interest rates going up regularly. Mortgages become more expensive, the cost of living becomes more expensive. It is crushing, and unfortunately we are living through that period right now. But I believe it was a lot worse in the 70s and the beginning of the 80s. Governments said it was the number one priority, really, economic policy, was to fight inflation. And I remember, for example, in the late 80s, early 90s, UK government deciding they were going to have a peg to the German Deutschmark, because Germany had been so incredibly efficient at fighting inflation ever since the issues when they had hyperinflation after the Second World War. So that was it. Germany had the answers, and if you tied your currency to the German mark, it was believed that you would automatically import this low inflation environment into your economy because the Germans were so good. So if the Germans raised interest rates, you would raise interest rates in line to keep the economy under control. And if they cut interest rates because there was a bit of slack in the economy, you would do the same. So if you basically track the Deutschmark, and you would import this low inflationary environment into your country. Well, it didn't work actually, because in 1992, when I was trading interest rate options on the London International Financial Futures Exchange, it went absolutely crazy because it was unsustainable, and the pound was artificially too high, and it was just crushing the UK economy. The economies were out of sync. Germany had a very strong economy after the unification. As I say, interest rates were artificially high in the UK, and the system broke down. That's when George Soros famously broke the Bank of England, as the headlines said, and the government was forced out of the ERM mechanism, and they were forced to cut interest rates, and the pound fell to a more competitive level. And actually that really worked for the British economy in the end. The economy needed lower interest rates and a lower pound, and became more competitive. So there was a time when the British economy started to improve. Anyway, I'm going off on a tangent now. The point being, interest rates were quite high, but they were coming down steadily. And as you can see, Then we entered this really low inflationary period. I can't remember exactly when it was, but kind of end of the 90s. China, which hadn't on the global economic stage really, it started to open up, become more of a market economy. So manufacturing shifted quite quickly from other parts of the world into China, because basically none of the rest of the world could compete with the low wages and the resources that China had. Very efficient, they could set up factories in a heartbeat and be producing all the goods that we wanted in the West at a much cheaper price, ship them over to us very quickly, very efficient, very cheap. So we then entered this period, just as interest rates were coming down and inflation was becoming under control, this situation of low inflation was accelerated. It was improved because the East became the world's manufacturing capital. So all these goods that we seem to be unable to stop consuming were being produced and sent over, and we were just buying everything that China could produce at a low rate, because of course they were paying their workers whatever it was, $1 a day. They're bringing all these workers in from the farms and whatever they were doing before, and setting up these huge factories, and these cities were just sprouting out of nothing. But eventually the problem is we've lived that for the last 20 years or so, which really has brought inflation down. Now people think, you think back maybe, and maybe you're not as old as me, so you just think that this is normal. Inflation is low, you buy whatever you want, you borrow as much as you like, because interest rates are so low, and this is the way life is. You buy as many houses as you want, you rent them all out, you're paying a 2-3% mortgage rate, you're getting 5% yield on your property, you want a new BMW every 3 years, you want a new Mercedes every 3 years, you want to go on holiday. You think that's normal. It is not normal. This was a 20-year period, or maybe 25-year period, which is completely abnormal, because China is no longer paying their workers $1 a day, I'm afraid. China is now becoming a much wealthier country. Citizens are doing well. There is a demand-driven economy rather than an export-led economy where they're just bringing money in. But the other thing that China was doing is earning all these dollars, earning all these euros, and then my understanding of it is, and please correct me if I'm wrong because I'm just guessing, but they were using all the dollars and euros. Of course they were bringing some of that money back into the country, but they were also by investing in US bonds and European bonds with all the cash that they were making. So that was another factor that was keeping interest rates artificially low, as if we needed anything else to stimulate the economy and keep the interest rates low. Every time there was a blip in the economy in the West, so for example, dot-com bubble, when that burst in 2000, 2001, we had the global financial crisis in 2008, 2009. Instead of what would normally be allowed to happen, the economy is allowed to have a downturn, have a recession, employment is allowed to go up. Some people unfortunately have to lose their houses, asset prices come down a little bit. It's just a nice little reset, which unfortunately is part of the cycle, because the economy is not supposed to grow indefinitely. And we even had, I remember back in the old days having Gordon Brown saying, we have beaten the economic cycle and we can just look forward to a continued economic prosperity. Crazy. Even politicians thought that we would never have a recession again. And for some stupid reason, they decided that was what they needed to do. Never have a recession again. Nobody should be unemployed. Everyone should be able to borrow as much money as they want. So every time, as I say, global financial crisis, classic example. Now, they slashed interest rates quickly. I'd never heard of quantitative easing. I didn't understand what it was. And suddenly this concept comes on board where basically they just print money, create money at the central bank, and then buy bonds like it's going out of fashion. Everyone who owns bonds sees the value of them go up. Investment banks mostly, I would imagine. They've got all this money coming back to them. They can lend it out, do whatever they want. So all this money comes back into the system. I'm sure no matter who you are, if you're involved in financial markets, you must be aware of the fact that interest rates have been kept artificially low for the last 15 years, ridiculous amounts of money printing. Just Google it, look at the charts. It's just off the scale, the amount of debt that we now have, because governments just didn't want the general public to suffer any sort of unemployment or fall in asset prices. And as long as house prices were going through the roof, they thought everyone will be happy. They'll vote us back in. Everything will be rosy. We all know the bubble had to burst. Inflation had to take off eventually. Too much money sloshing around the system. It was probably triggered, yes, by the war, forcing energy prices up. I know that fertilizer prices have gone up, so now we have problems with food and there's supply chain issues, blah, blah, blah. But this is always going to happen. Now, if you think that inflation is just going to take off temporarily and then it's all going to come back down to 2% and then we're going to carry on living the rest of our lives with this low inflation environment and we're all going to go back to borrowing loads of money and having loads of houses and having loads of cars, I just don't think it's ever going to happen. Because one of the main reasons is we don't have China now anymore paying ridiculously low wages for all the products that we want. That's over. I just don't see how inflation, it's not normal. Look at this chart. It is not normal for, this is a period throughout, the beginning, after the turn of the century or even just over the last 13 years, where interest rates were below sort of 3%, but it's not normal. It's not something that should happen. So, and I think that the fact that we've now got on this chart here, we probably got a floor around 2.7, 2.6%. For US interest rates, just judging on a technical analysis basis. So I think that what I'm trying to say to you is it was an unusual period over the last 10 or 20 years. If you think we're returning to that, I don't think we are. I'm not going to go into, the main reason is that, of course, we can't produce goods at those low prices that we did over that period when Asia came in and became the world's manufacturing capital. Look at the oil price, for example. So this is the oil price going back to 1980 as well. The peak of the oil price in 1980 was $40. Okay, well, it has been creeping a little bit higher, but even now, around $85. Well, that's where we were around 2010, 2012, when we didn't have particularly strong economic growth. Okay, it did go a bit crazy. Oil went up as far as $147. That's the peak. That was just before the global financial crisis. I remember there was all this talk about at the end of oil and the oil supply was going to run out. I think we all know that that isn't the case now. So that was an extreme. But even when things were absolutely catastrophic, okay, oil got down to $33. So we're about 3 times that price now, but we're not at an unusually high price for oil. When you look at it historically, you go back to 2006, the peak was $78. So what I'm trying to say to you is prepare yourself, because I just don't think that inflation is ever going to get back down to 2%. I think this is going to be a persistent problem in the economy. The other thing is, one last point that I'll finish on, and I don't know whether this is particularly relevant, but the world has a finite amount of resources, okay? There are some resources that we just can't produce more of. When I was born in 1968, I think the world population was 3.5 billion people. In my lifetime, I'm 54, we've now got 7 billion people on the planet. So the population has doubled. So the demand has doubled. We need twice the amount of houses, we need twice the amount of food, blah, blah, blah. The amount of cars that people have, it's insane. So demand is not going to go down. From my understanding, the population will continue to grow. We've got an aging population issue where we've got so many people living so much longer, but not actually producing anything and not really contributing to the economy because they don't spend much. Anyway, look, I want to hear your comments. These are just the thoughts off the top of my head that were generated during the week, and I just wanted to get them down on the video to generate some discussion. So please, let's hear from you and hear what you have to say on the subject.